Hello, I'm Brian Beaulieu, CEO, Chief Economist of ITR Economics. Thanks to you for joining me for this edition of FedWatch, March 17th, 2023. It's been a busy week. SVB and Signature Bank both needed to be really taken over, closed, processed, whatever word you want to use, they failed. Very different reasons, and Signature was the third biggest bank failure in U.S. history, so that's notable. I think more notable, but people like to talk about SVB. A few words about that. I mean, what they did to themselves. They had a poor plan for dealing with some tight conditions they were going through because they're involved in high tech. There wasn't a whole lot of loan opportunities. Stock prices were falling. That whole thing. I mean, everybody knows what was going on in the high tech sector. And they decided to invest the excess liquidity into bonds. Well, we all know what interest rates did over the course of 2022 and so far in 23. So their bonds took a beating. And they weren't in short-term bonds like most banks do, virtually all banks do. They went into 2-year and 10-year bonds to try and maximize their return. Bad play. They maximized their loss. So they had a bad plan, poorly executed, and they lost. The Signature Bank, more known for its connection to cryptocurrency market, and that's been a world of turmoil also. Not a surprise that they got some mud thrown on them and they ended up going down. First Republic got bailed out before anything really bad could happen to them. They're sending emails out to their customers telling them we have lots of liquidity. And then most recently, it was 2 days ago, yesterday, Credit Suisse announced that they were in trouble. So the Swiss central bank put 50 billion into that institution to stabilize it. And the headline today was that it bounced up 20% in value. 20% off a very, very low number. They're not even close to where they were before they took the fall. All of which means is this systemic, or is this or are these just weak banks that are getting hit by the interest rate environment? Credit Suisse was known to be a weak bank to begin with. They were heavy into bonds as well. A financial friend of mine sold his bonds 6 months ago because he didn't like what was coming out of Credit Suisse. So people that were aware of what was going on knew that these things were happening. And our point of view is this is not a systemic risk. These banks had particular problems. That doesn't mean it couldn't spread to, a bank run out of the 1930s, which everybody is so afraid about all the time. But the Fed stepped in with a very heavy hand, like they usually do, and essentially guaranteed all deposits, whether it's over $200 or $250,000 or $2 million. It doesn't matter. All deposits are covered. They did this in 2009, and it was effective at stopping a panic, and it should be effective. Now, from our perspective, the bigger issue is beyond all the noise from the bank failure, the 2 bank failures out of 513 chartered banks in the United States. The question is, what else is the Fed going to be doing? And there I want to talk just a couple of minutes because I try and keep these short for you. The unemployment data, there are some things in there that we didn't like. I know it continues to show very low unemployment number. And the irony there is the Fed's trying to fix something that was systemic to us in 16 and through 2019 in terms of being at virtual full employment. We're running at 4% unemployment in 2018 and 19. We're just back to where we were before, and the Fed now thinks that they can fix this problem by bludgeoning demand. We looked at the unemployment numbers. We used not seasonally adjusted, and there was a little hiccup in those numbers that was reminiscent of the 2014 trend. And that's significant because it was in August 2014, U.S. industrial production peaked and moved downward. So we're watching that number very carefully, and we encourage you to watch that number very carefully also. Unemployment rate, not seasonally adjusted, should go down for March, April, and May, and then go back up in June. That's the normal pattern. If the unemployment rate goes up sooner than June, that's a sign that the economy is weakening and that we're we're on track for late 2023, seeing the industrial side of the economy begin to slip and GDP go down in 2024. And I'm hoping, and hope is a dumb strategy, but I'm hoping that the Federal Reserve knows this also, and that they will stop raising interest rates. Right now, apparently, it's a flip of the coin whether they're going to continue raising interest rates or not. We don't know. If they stop raising interest rates, that would be great news. They could stop further damaging the economy with these rate increases, and that would help mitigate the potential of an even more severe decline for the economy in 2024. We've been telling all of our clients one of the risks to our forecast is if the Fed goes too heavy on these interest rates, the 2024 decline is going to be even steeper. If they lighten up, that helps us in terms of seeing a mild decline or even a milder decline than we are forecasting, all of which is great. Retail sales numbers were within normal for February, but again, weaker than average, weaker than median, and therefore not great. That's another sign that we are decelerating. It's those darn inflation numbers that aren't coming down sufficiently to please the Fed. Everything else is moving in line from what we can see when we look at the nuances and the trend. So we're guardedly optimistic that they'll forego a rate increase when they're meeting March 21st, March 22nd. We'll find out what they do then, but it wouldn't surprise me if they don't make a move. They sit on their hands a little bit and they decide whether they want to do one more in the second quarter or more in the second quarter. No movement would be good news. March 23rd, so the day after the Fed announcement, Kyle Stevens, a fellow economist here at ITR, and me, we're doing an executive series webinar, an ITR executive series webinar. We're hosting it, and we'll be talking about recent Fed decision and risks to our forecast and what it all means. That webinar is called Stormwatch. It's a takeoff on FedWatch. So you are welcome to join us for that. Hope you do. And in any event, we'll be recording one of these for the 24th of March. Thank you for joining us for this edition of FedWatch.